Today's example, I'm going to show you capitalizing your banking system with $10,000 premium deposits each year. Now don't get hung up on the numbers. They can be any number you want. Matter of fact, the minimum for you to set up your infinite banking concept would be 10 times your age. Now, what does that mean? Well, I'm 46 years old, so if I add a 0 to my age, that's $460. That's the minimum monthly amount in order for this to work. So when I say 10,000, I'm just picking a number that's nice and easy for division and multiplication. But your number could be significantly different. Your number could be 5,000 a year. Your number could be 5 million a year. You see, we design the policy based on the amount you want to save in your private banking system. So in this case, for this example, we're going to save $10,000 a year in premium deposits. Now, if I put over here the cash value in the money multiplier account, you will see that in the first year, if we put $10,000 in, we have just shy of $6,000 available. The second year, we put $10,000 in this example, and you have $12,000, a little more. In the third year, you put $10,000 in, and you have $29,204. So in the third year, what we're going to do is we're going to buy a car. We're going to buy a $25,000 automobile. Again, if the numbers don't work for the car you want, add a 0 and go buy that Ferrari you want, but add a 0 to the amount you saved as well. But the $25,000 that we took out of that cash value money multiplier account really never left the account. So in the third year, even though you took $25,000 out, you still have $29,204 earning uninterrupted compounding interest, which means you're getting paid a guaranteed interest rate plus a dividend from the insurance company, and that money's still in there compounding. So whose $25,000 did we use to buy the car? Well, we used the insurance company's money. The insurance company gladly would lend us our death benefit while we're living. Because remember, there's two promises the insurance company gives you. One, they'll pay you a guaranteed interest rate, and number two, they're going to pay a death benefit out when you graduate and go on to heaven. But that death benefit doesn't only have to be paid out when you die. You can use that money while you live, up to the amount of cash value that you have, because the insurance company is going to collateralize that $25,000 loan with the cash value that you have built up. So now you understand how you earn uninterrupted compound interest. You're using the death benefit early, and the insurance company is charging you interest on that loan. But the interest and dividends you're earning on the cash value, uninterrupted compounding, you're actually being charged by the insurance company on that loan of them advancing your death benefit. So now that you understand why we use this machine from a standpoint of compounding and also the ability for your money to work for you for the rest of your life, now we gotta apply the process. So we changed where the money went. Now we have to add one more step. Remember, I told you I'm gonna teach you how to be the bank. And if I'm gonna teach you how to be the bank, that means you gotta be an honest banker. You gotta treat your money the same way you would treat a traditional bank's money, which means you normally would make a monthly payment to a traditional bank for a car loan, right? So you took a loan from your private bank, so you don't want to steal that money. So what you're going to do is figure out exactly how much that payment would have been with someone else's bank. And you remember we did the math. It was $483. I'm going to round it up to $500 a month, just for simple math. You're going to make a $500 a month car payment, but you're not going to make it to somebody else's bank. You're going to make that car payment back to your private bank, which is that specially designed whole life. So when you do that, $500 makes its way back into your policy. It reduces that loan that the insurance company advanced you. And by the way, the loan never needs to be paid back because it's in advance of your death benefit. The insurance company will be paid back the loan the day you die if you didn't pay it back. But I'm teaching you the infinite banking concept, which means we're going to be an honest banker and we're going to make $500 a month payments back to your bank, because I'm going to show you this is the best way for you to build wealth and get all the money back for every car you buy, drive, and own. So let's get into the math now that you know what's going on. So for 7 years in this example, we saved $10,000 in that specially designed whole life. And we then took and paid back our policy $500 a month, which is $6,000 a year. So if we do that times the 5 years that we made those car payments back to our policy, that's $30,000. So if we add $70,000, your premium deposits, that was the capitalization of your bank, and we add the $30,000 in car loan payments you made back, that's $100,000. But then what we did is we took out $25,000 to buy the car. So if we do 100 minus 25,000, that means our true net injection into your private banking system is 75,000. Now, let's go over what happened in this first 7 years. You saved money, you used the infinite banking concept and that specially designed whole life. So what happened at the end of it? Well, first off, the car that's in the driveway is bought and paid for. Second off, if you look at your cash value in year 7, that is $67,881. If you put $75,000 into your banking system and you got $67,881 still in your policy, that means that you got 91 cents of every dollar back for that first car that you bought. That's pretty impressive. I bet you nobody watching this video right now knows how to get 91 cents back of every dollar that you pay for a car unless you sell the car. But indeed, in this scenario, you didn't have to sell the car. You just got 91 cents of every dollar back. But you see, there's something that happens when a car hits 5 years old. The brakes start to go, your tires are probably bald, your car starts to break down. So what do? Well, we buy another car. So what we're gonna do is in year 8, we're gonna do the exact same thing. We're gonna repeat the process. We're gonna buy another car. But what we're not gonna do, and this is just for examples, we would never tell you to stop making premium deposits into your banking system. But for this example, we're not gonna make any more premium deposits from years 8 through 12. Not another dollar is going to be saved. But we're still going to take $25,000 out in that 8th year and we're going to buy another car. And then we're going to make $500 payments back to that policy, repaying the loan that you took from your death benefit. So if we do the math here, there's 0 new deposits. You repaid $30,000 for that second car you bought, so that's 30 grand, but we subtract $25,000 for the purchase of the car. So 30 minus 25 means in years 8 through 12, your true net injection into your banking system is $5,000. If we look up to the cash value in your money multiplier account in year 12, it is $91,473. In year 7, you had $67,881. If we subtract the 2, that means you made $23,592 for buying 2 cars. And both cars are now bought and paid for in the driveway. But you see, you didn't make $23,592. That's just how much your account grew. If we look at your true net injection from the first 7 years, it was $75,000. In the next 5 years was $5,000. So 75 plus 5 is how much? $80,000. So if we look at your cash value of $91,473 and we subtract your true net injection of $80,000, how much did you make for buying 2 cars? $11,473 is the amount that you made for buying 2 cars, which are now in the driveway, which still have value and you could sell tomorrow or gift or give away or let your kids drive. So now I have effectively showed you where your money is going to go, that one change. I've shown you what that second thing is that you're going to apply, which is the infinite banking concept. I now showed you how to get all the money back for every car you ever buy, drive, and own, but there was some rules you had to follow. There were specifically 3 different rules to make that work. So let's just cover the 3 rules. First off, you had to pay yourself first, didn't you? You had to save that money to capitalize your bank. The second rule is you had to pay yourself with interest. You see, when you took the loan from your bank, you repaid that loan with interest, the same way you would do it with any traditional bank or any finance company that you have ever borrowed money from. You're just being an honest banker. Number 3, you recycled and recaptured all the money you used to give away. So what does that mean? Well, the way you buy cars today, whether it's a lease or a finance, you give that money away every month. You recycled and recaptured that. Although you made monthly payments back to your policy, I want you to be aware that every dollar that you repaid back to your policy is money that you had to use the next day. You see, when you make a car payment now, if it was a $500 car payment to a traditional bank, you can't go back to the bank and say, hey, I need that $500 back. I kind of had an emergency. But when it's your private banking system, like I just taught you, that $500 is in your cash value the moment your check clears. And all you had to do is follow 3 separate rules. If it works for a car, what else does it work for? Well, it works for everything, folks. But let's move on to what I think is one of the biggest problems in this country, and that's debts. You see, if you look at statistics, as of 2023, credit card debts have reached all-time highs. So I'm going to refer to a real case study of a chiropractor that came to us after watching a video very much like what you're seeing. He came to us and he said, "Can you help me?" And we said, "Sure, what's your scenario?" Well, he said, "Here are all my debts." You can see them on the screen right here. He had 9 third-party debts totaling $478,774. He was making payments every single month to somebody else's bank, all listed there, of $5,777 every single month. That's $69,324 a year he was giving away that would never come back to his family ever. And he said, "How can you help me take back control of this money?" We first said, "Okay, Mr. Chiropractor, how much money are you saving today?" He did some calculations and he said, "Between my 401k and my savings accounts, I save about, well, it was a little more, but about $25,000 every year." And then what I said is, what if all we did is we stopped saving for a little, we took the $25,000 and we paid down your debts with that money? Seems logical, right? How long would it take for us to pay off all of these debts on their current payment schedules? The answer, 19 years by the math. That was unacceptable. So we said, well, what if we change one thing, Mr. Chiropractor, and that is where your money goes first. What if we put that money into a machine, a specially designed whole life, and then we add one step and we apply the infinite banking concept? How long will it take to pay off Mr. Chiropractor's debt? The answer, 6.5 years. Let me walk you through how this worked. So the first year, the simple change was we set up a specially designed whole life for this chiropractor. And we put that $25,000 deposit into that whole life. And when we did that, we immediately took a loan out in the first 30 days. Let me repeat that. He put $25,000 into premium deposits into that policy. We immediately took a loan from the policy in the first 30 days. And that loan amount was for $14,863. We took the $14,863 and we paid off Discover. We paid off Lowe's. We paid down Nordstrom, which means we reduced his debts from $57.77 a month to $53.29, which means that freed up $448 every single month. We said, "Mr. Chiropractor, we need you to go to your local bank, wherever you do your banking. We need you to open up a second checking account. We're going to call this your segregated account. And we want you to save that $448 that you used to give away to Discover and Lowe's every month. Put that in this newly created checking account called your segregated account." Everybody's tracking what I'm doing here, right? Nothing hard about this, nothing complicated at all. Second year, what are we going to do? We're going to do the same exact thing. We're going to take the $25,000, put it into the policy. We're immediately going to take $16,571 out in the first 30 days. It's more than it was the first year because now you're compounding. So we take $16,571 out of the policy as a loan, and we also have saved in that separate bank account $5,374. That's a total of $21,945 in the second year. So what do we do with that $21,945? Well, we're going to pay off Nordstrom, we're going to pay off Wells Fargo, we're going to pay off the private loan, we're going to pay down BMW. His current debts in year 2 are $378,013. His monthly payments are now not $53.29, they're now $38.60 every month, which means he now has the ability to recycle and recapture $1,917, which is money he gave away to Discover, Lowe's, Nordstrom, Wells Fargo, and the private loan. He just did this every month. Now, he still makes those payments, but he pays them back to himself in that segregated account. So year 3. Year 3 is always a magical year for most of our members. And the reason for that is in this scenario, the chiropractor put $25,000 in, and how much was he able to take out immediately in the first 30 days? More than $25,000. You see, now the compounding caught up, and he's able to take $25,541. Now let me pause for a second. You understand that in the first 2 years, the amount of money the chiropractor put into the policy was not able to use 100% of the money. Matter of fact, in this example, which is a bad example because the one we would design for you in today's world is going to be far better than this. But in this example, for the first 2 years, he had less money than what he put in. But the third year represents what we call the efficiency point. It is the point in which the policy, the money you put in that year, you're able to take out more than what you put in. And that means that now your compounding interest has reached a point where it is working in your favor. But for the first 2 years, this client lost money. For some of you, that's not acceptable. But for this client and all the thousands of clients we have, they accept that because they also get a death benefit. And the death benefit does cost money. Insurance companies are not nonprofit. So the amount that is paid for the death benefit really shows its ugly face in the first 2 years, like you saw. But now the third year, we have broken even on the cash-on-cash return. So that $25,541 plus, he was saving $1,917 a month in that segregated account. If we add both of those together, we add $48,545 in the total amount we can use. So what are we going to do with that? We're going to pay off the rest of that BMW loan. We're going to pay down that West Marine boat loan. We're going to pay down the condo. So 3 years into this, the chiropractor now only owes $283,146. His monthly payments to somebody else are now $2,100, and the amount he's recycling and recapturing into that segregated account is now $3677 a month. Folks, this chiropractor did not have to work harder, this chiropractor did not have to work longer, and this chiropractor did not have to take on any additional risk. All he did is changed one thing, where his money went first, and applied this process. So realistically, that's the marathon that I talked about early on. The marathon looks like this. How much money did he put into the policy? Year 1, 25, year 2, 25, year 3, 25. He put $75,000 in the policy. But every year, immediately in the first 30 days, we took loans from the policy. $14,000, $16,000, and $25,000 over 3 years. That's $55,000. How much money is left in his policy? Well, for many of you, you take the 75 minus the 55 and you think that there's 20,000 left. But you're wrong. There's 75,000 left. Remember, we're not taking our money, we're taking a loan from the insurance company. We're just using our money as collateral. So as we move on, now we're on year 4. What are we going to do in year 4? The same we did in all the other years. We're going to deposit $25,000 in premium deposits. We're immediately going to take a loan from the policy in the first 30 days, and that's going to be $26,304. But we were saving $3,677 a month in that segregated bank account. And just for the record, that segregated bank account, should this chiropractor have had an emergency or something come up, that money's liquid, and so is the cash value. So if the chiropractor couldn't have stuck to this initial plan that we designed for him in our mapping process, this chiropractor would have just taken longer to pay off all the debt. But he did stick to the plan. So totaling up the segregated account, which is $44,124, plus the cash value loan, which is $26,304, he had $70,439. So what are we going to do with that? We're going to take that $70,000, we're going to pay down that condo mortgage. But by paying the condo mortgage down, we didn't reduce the amount he owed to the banks because these are mortgages. When you make a principal payment, it doesn't reduce the monthly payment. So his monthly payment to other banks is $2,100. The amount he's recycling and recapturing remains the same at $3677, but now, year 4, he only owes $187,515. So year 5, we do the same thing. $25,000 goes into the policy. $27,090 immediately is taken out as a loan in the first 30 days. We saved $44,124 in the segregated account over the 12 months of year 5. So we have $71,225. So what we do with that is we pay off the condo. We pay down his primary house. So now, year 5, he owes $91,099. Not too bad at all. But the monthly payment that's being made to other banks is now only $1,221, and the amount that he's recycling and recapturing is $4,556. That's only 5 years into what would have taken him 19 years doing it the old-fashioned way. Not bad. But the 6th year, something happens. You see, there's rules for this. He was putting $25,000 into the policy, and in his first policy, he hit his MEC limit. Now, today, the way we design policies, we have 10 years we can do this for. But back when we did his, the 6th year was the year he could no longer put $25,000 into the policy because he hit his limit. He could only put $10,000 in that first policy. But when he took the loan out immediately in the first 30 days, it was $13,092. Hold on a second. He put $10,000 in premium deposits in that policy in the 6th year, and he took $13,092 out. What's his cash on cash return on that? For any of you that said over 30%, you're right. That's how much he made because of compound interest over 6 years on the original cash value balances. That's the power of compounding interest. So he was so excited about that, he opened his second branch office. In other words, his second policy, in which he deposited $25,000 into that second policy. So he took $13,992 out of the first one, $14,863 out of the second one, both immediately in the first 30 days, and he recaptured $45.56 a month in that segregated account. So how much did he save? $54,678 in that segregated account. That's a total of $82,633, and as you can see, the only mortgage left is $76,450. So 6.5 years later, he paid off all of his debts. He's now got $57.77 a month getting saved in that segregated account, which he's then going to take and use that money to repay the loans to the policy so that money is reinstated, so he's not paying interest on those loans to the insurance company. All the while, he's been making uninterrupted compounding interest on all of his money, and he's debt-free 6.5 years later. You see, the complicated part about that is really nothing. There's nothing difficult, except for it would take time to manage all of that year in and year out. So this slide right here represents what we call the debt map. We do this for our clients. For every one of our over 6,000 clients in this country, we do a mapping call. We work with our clients to solve their problems. We create a map. It's kind of like your GPS. You give us the destination, and we create the GPS, the map, so that you get there. And we work with you on a quarterly basis to make sure you stay on track or to make changes as those changes are needed. Folks, I have literally just shown you one of the biggest secrets when it comes to wealth. We only talked about cars and debts, and there's so much more. That's why it's called the infinite banking concept. But we needed a goal. Whether it's buying cars, paying down debts, lending money out, buying real estate, whatever it is you want to do with your money, all you're doing here, folks, is changing where the money goes first. You're not doing this in place of buying stocks or in place of investing in real estate or doing private loans. You're doing this in conjunction. It is the and asset. It is this and whatever you want to invest in. The only difference is you just found a way to make money twice. And you also found a way to benefit from the infinite banking concept and recycling and recapturing all the money you're giving away. So your goal, well, it does take time to hit that in some cases. But how do you eat an elephant? One bite at a time. How does a man get to the top of a mountain? One step at a time. Is it possible to owe no man nothing? It's not. There's always going to be things you're going to need to buy, whether that's cars or vacation homes or pay taxes, whatever. There's always a use for the money that you save. I just showed you how to make that money work for you instead of working for somebody else. That is all we did. And if that chiropractor that we just talked about continued to make the payments as promised in the old way, back to the banks, here's what he would have paid. He would have paid $879 a month for that condo mortgage, 251 months, that's $220,528, and he would have made his payments to his house, of course, $1,221. He had 224 months left, that's $273,439, meaning he would have given somebody else's bank $493,967. Now, who's going to get that $493,967? His private banking system. But see, he is earning more than 4% on his money. So what if he just earned 4% on all of that money, uninterrupted? You know, the compounding thing. How much would he make? Well, that would change the game, and he'd now have $749,611 in the exact same time frame. Folks, don't ever underestimate the compounding interest and the power of that. But you have to understand that your money doesn't have to sit still to earn it. Folks, if you like what you just learned, then please book a call. There's a link in the description that you can book a call. But now that you know this, everyone should know this. You got to tell people about this, because if you don't tell your children about this, then I think you're stealing from your children and their grandchildren. So please spread the word. By the way, we never even talked about the death benefit, did we? But that death benefit will pass on to your beneficiaries tax-free someday when you graduate. Not only that, I did mention this, but I'll hit it again. The loans that you took from the policy, well, they don't have to be repaid, because when you graduate or die, the insurance company will true up and subtract the loans from the death benefit. That's how they give you the loans and don't ever need them paid back. The internal values grow tax-free. The policies are exempt from judgments and liens in most states. Come on, this is pretty awesome, you must admit. Warren Buffett would say it like this. He would say, if poor people would just do what rich people do, they wouldn't be poor anymore. Folks, if you're interested, click the link in the bio, schedule a call with one of our money mentors, or right here on the screen, scan that QR code. That'll get you right over to the link to book a call, or you can text money to 833-217-3854. I hope you've enjoyed this. Now, go out there and take back control of your money and be your own bank. We'll see you next time.